I decided on ice cream because, well, number one, I loved it and I loved the product. And I was developing it myself at home. It was a really organic process. It just happened. I started making it for myself. It's such a great business to be in. I get to sell ice cream, and it doesn't matter if it's rainy or if you're on the beach and you're soaking wet. Like, people will still eat ice cream, and how cool is it that we make ice cream for people to eat on the beach? Calculating the gross profit is obviously really important because it has to be the backbone of the company. So we've got the financial model that we want to meet, that we will be meeting over the next 5-7 years.
I'm Nicky Larkin. I'm from Gorringe Accountants. I'm the Managing Director and founder of the firm. We calculate gross profit from two key figures. That's your sales less your direct costs. Now, sales are essentially what you're billing out to your customers. That is your services and products, depending on what type of business that you are. Now, sales, don't get confused because it can be called different things. It can also be called revenue, turnover, sales. They're all the same thing, but it's that figure less your direct costs. Now, your direct costs are your costs that are directly attributable to your sale. So it will be, if you're selling products, it will be the cost of you purchasing those products. So for example, if you're selling cans of beer, it will be the cost of making those cans of beer. So that is a direct cost. If you're selling your service time, it will be the time that you've taken for that particular sale. So if it's consultancy, it will be 1 day of your consultancy time as a cost, less what you've actually billed out to your client.
We've got various different revenue streams. So we've got distributor streams, we've got supermarket streams, and we've got international streams, and we've got direct streams. So 4 different streams of selling to people, all for different prices. What we do to calculate our gross profit is just plan the sales that we predict for each of those 4 customer segments.
Then what you do is you take that total sales figure, take away the direct costs, that equals your gross profit. That gross profit figure is really key because then after that you take off your overheads to find out your net profit figure.
All of those assumptions just go into our formula on our cash flow forecast, and then it generates our overall GP, predicted GP. And then, you know, there's a lot of sense checking. And once we're happy with it, we feel like, yeah, this looks doable, this feels right, then we kind of sign it off.